Flippity floppity hoppity hoppity. Welcome back, everyone, to another Federal Reserve Open Market Committee Minutes. This is obviously from the July 31st meeting, and it's going to give us maybe insight into the September rate cut meeting. Question mark, question mark, question mark. Anyway, we'll find out what's going on. We've got a lot of enthusiasm about this. So let's see what we get. We will see if they want to tee up any of those delicious, juicy cuts, or what it is they're gonna do to us. How dirty are they going to be to us? We will find out together. Anyway, the minutes are out within about 2 minutes. Yeah, we'll go through, we'll make some notes, and kind of see all the goodies that are going on, listen to some of the sizzles and all that stuff. But anyway, again, I do think it's a special sort of Fed minutes release. How special is it? Oh, well, I'm glad you asked. I think it's special because it's really the first, or I should say the last set of minutes that we get before this potential rate cut that everybody's expecting. So naturally, we would expect to see some form of commentary around easing or who knows what. But anyway, the Qs right now are actually going up into this release. Things were dropping there for a hot minute just after the start of the open. You got TLT up about 30 basis points. The Qs are up about 40 basis points going into this. You've got, what else do you have here? Rocket Mortgage is up 2.2%. Wow, United Wholesale up 2%. Tesla up 67, almost at 60K on Bitcoin. Palantir slightly negative, although it's been doing very well lately. So let's see what we get. Minutes are out in just a moment. What we'll do as they come out is I'll probably read out some of the headlines as I try to get the PDF up. You got to work hard to get it up. And then once we have the PDF up, we'll just take the handy-dandy pencil and get right into analyzing it. All right, here we go. So, let's find out what we have. I'll listen in over here for a moment. Oh, here we go, actually. We have a vast majority of participants says it would likely be appropriate to ease at the next meeting. At the next meeting. There it is, at the next meeting. So they just teed it up. Just teed up the rate cut. Let's go. Rate cut teed up. Moon. Outlook for economic growth in second half has been marked down largely in response to weaker than expected labor conditions. Participants observed in recent months there had been some further progress to the 2% inflation target. Yes, so they definitely tee up this rate cut. That's great. Several participants said reducing policy restraint too soon could risk a reversal on inflation. Participants observed in recent months there had been further progress to 2%. Okay, that's generic. Participant unemployment rate provided plausible case for 25 basis point cut at July's meeting, or that they could have supported such a move. Wow, they're basically saying they could have gone for 25 in July. I wonder if that's a way of kind of setting up for maybe a, 50 basis point cut coming up. But boy, if you're making some tendies right now, make sure to use a little bit of those tendies on those courses on building your wealth. We got the coupon code JHOLE going, so make sure you join us there. We do course member analysis every day the market's open. Love to see you there. And you kind of get to see how I'm positioning as well. Not as personalized advice, but just as perspective. Okay, let's get into the minutes. It looks like they've, there we go. We have all the minutes. So we're now going to start going through these. Again, market's initial reaction, very happy. Let's flip on over here. Okay. Okie dokie then. So I want to see where they said 25 basis point cut. There we go. Here it is. All participants supported maintaining the target range, although several observed that recent progress and increases in the unemployment rate had created a plausible case for reducing the target range 25 basis points at this meeting, or that they could have supported such a decision. So in my opinion, this may signal 50 BP in September at least by some of the members. So I think that's interesting. What about job market? Let's focus a lot on jobs here. What do we have here? Regarding the outlook for the labor market, participants discussed various indicators of layoffs, including unemployment claims. No. Unemployment claims are so lagging. It's stupid. Some participants commented that these indicators had remained at levels consistent with a strong labor market. So some were like, hey, no, everything's Gucci, everything's fine. Participants agreed that these and other indicators of labor market conditions merited close monitoring, though, and several said that companies were managing headcounts through selective hiring and attrition. Now, remember what what they mean when they say attrition. They're basically saying, "Hey, look, we're just gonna not hire, and what we'll do is, as people leave to move on and go do other stuff, we'll just let them leave, and then we'll give those responsibilities to other people, and essentially not refill those spots, right?" That's what they would mean with attrition. Okay, I'm gonna go ahead and pull up as well just to see, watch what the suits are saying. But I'm always a big fan of going to the primary source. Participants noted real GDP was solid through the first half of the year, though slower than the robust pace from last year. Okay, that's fine. Let me go to look at some more jobs information here. The monthly pace of payroll job gains had moderated from the first quarter, but had been solid in recent months. However, many participants noted the reported payroll gains might be overstated. Yeah, you don't say. And several assessed that payroll gains may be lower than those needed to keep the unemployment rate constant, with a flat labor force participation rate. Participants observed that other indicators also pointed to easing in labor market conditions, including low hiring rates and the downturn in job openings. Yeah, that's how recessions begin. Let's make just a note here. Even the Fed was concerned about misleading jobs data before the revision data today came out. Remember, today just represented March 23 to March 24, which means we could have seen even more weakening since March. There we go. So keep that in mind. That data we got this morning is really kind of old news. The concern is, what does this mean now going forward? Is this going to be even more scary? I don't know, but we'll see. Okay, ratio of job vacancies to unemployed remained at 1.2, about the same as the pre-pandemic level. Usually this falls to like 1.0, 0.8, but anyway, in more recessionary times. But it's also, there's some other factors related to calculating this that can be a little complicated and not give us accurate insight right now. Recent indicators suggest that economic activity can continue to expand at a solid pace. Job gains have moderated. Unemployment rate has moved up but remains low. This is also true. This is, something where this talk about remains low is dangerous, in my opinion, because technically, if you sort of look back into history, historically, unemployment rate sat around 5.5%. So theoretically, they could just not cut and say, oh, it's still historically low. Could slow rate cutting, which is dangerous if we overdo it and create a recession, right? I'll make a little note of that. Okay, job gains have moderated. We saw that. Moderated, fine. Okay, what about... we saw the 25 BP. What about reducing the rate? Let's see if we can get a little bit... Oh, those are a lot of matches. Fed funds. No, they don't mention Fed funds. Let's go with rate. But rate tags too much. Mortgage rates... Delinquency rates. Participants noted that such strains were evident in indicators such as rising credit card delinquencies and the increased share of households paying minimum on balances, which would or warrant continued close monitoring. Okay. Some participants observed lower and moderate income households were encountering increasing strains as they attempted to meet higher living costs. Unemployment rate moved up but remained low. In addition, core non-housing services had decelerated in recent months. Yes, that's a good thing. Declines in input costs had helped reduce pressures on retail prices. With regard to the outlook for inflation, participants judged that recent data had increased their confidence that we were moving sustainably towards 2%, though they acknowledged the lags. Vast majority saw a September cut as likely. Almost all continued to expect a disinflation. Let's see here. Okay. Let's keep going here. Let's see here. Vast majority. I want to see where that comment is. There it is. Nevertheless, participants viewed incoming data as enhancing their confidence that inflation was moving towards the objective. The vast majority observed that if data continued to come in about as expected, it would likely be appropriate to ease policy at the next meeting. Many participants commented that monetary policy continued to be restrictive, although expressed a range of views about the degree of restrictiveness. A few participants noted that ongoing disinflation with no change in the nominal target range for the policy rate by itself results in a tightening policy. Yes, this is true. Several participants stressed the need to monitor conditions in money markets and factors affecting demand for reserves. All right, let's keep going. I want to go back to my rates search. Market's kind of bobbing up and down on this. It hasn't really clearly picked a direction. Tesla's up a little bit, 73 basis points. I'm going to make a Tesla video later, by the way. Stay tuned for that. Okay. A couple participants commented on the financial condition of low-income households, rising delinquency rates. Looked into that. Let's see here. Expectations for policy rates in foreign countries declined. I wonder if we have Japan in here. Oh, we do. Manager noted, continue to expect the Bank of Japan to tighten this year. That would sort of increase your carry trade problems, but this meeting occurred before the carry trade blow up. Not that they couldn't manipulate it, obviously. Okay. Market-based measures. Okay, that's fine. Funding market stable, fine. That's boring. Interest rates on new credit cards increased slightly. Auto loans, little changed. Interest rates on small business loans remained elevated. Delinquency rates on small loans to businesses remained slightly above pre-pandemic levels. Credit quality in commercial real estate deteriorated further. Oh, that's not good. That's not good at all. Not good for small banks, right, with commercial real estate exposure. The average delinquency rate for loans in the commercial mortgage-backed security sector and the share of non-performing commercial real estate loans at banks rose further. Both of them rose further. That is not good right here. Regarding household balance sheets, delinquency rates on most residential mortgages remained near pre-pandemic lows. Oh, what a surprise. I mean, this is part of one of my big theses here, that residential mortgages are pretty well insulated right now. Though consumer delinquency rates had increased, particularly amongst non-prime borrowers, the rise in delinquency rates for credit cards and auto loans actually slowed. Ooh. So a little bit more there on the commercial banking system, potentially. Looking at a little bit of pain. Okay. What else? Let's see what else we have. I'm going to try to move that. I want it to be close, but not to where it's in the way. So, I had some work to try to perfect the positioning of it. Whatever. Okay. Regarding household, okay, we looked at that. Let's see here. Office sectors and multifamily vacancy rates in these sectors continue to rise. Housing prices remained elevated relative to fundamentals. Ooh. Asset valuation pressures remain elevated, with estimates of risk premium across markets low compared to historical standards. Valuation pressures remain elevated in the U.S. financial system. Okay. Fraction of private firms, low debt surfing, blah, blah, blah. That's fine. That's fine. Delinquencies on mortgages remain low. Home equity remained high. Yeah, I mean, none of that is a surprise. That's all pretty traditional so far, what we've been seeing with this cycle. Although I do think you're going to have a little bit more of sort of a white-collar layoff cycle. I mean, that was reiterated by the numbers we saw this morning as well. It's not ideal. Okay. I think I've gone through all the hits for... Oh, no, not quite. Okay. Rates for the 30-year mortgage declined on the intermeeting period, but stayed high. Saw that. Okay, let's see what else we have here. So far, pretty consistent messaging. Let's see if there's anything particularly unique. Listen in here for a moment just to see what
central bank buying.
Let's see what Wall Street has to say via CNBC, and I'll also peek around, and then we'll come back to the notes in a sec.
Goes into gold, even if it's not in the form of the ETF. Having said that, I also think obviously looser central bank policies, which I think we're about to embark on here in the United States, is also helping to put a bid into gold prices as the dollar has suddenly weakened down to one or so on the Dixie, and we think the path of least resistance is for it to work lower. And of course, typically a stronger dollar is kryptonite for gold prices. So obviously it's helping to stiffen that tailwind for gold in the midst of everything else that is transpiring, not only with regard to central bank buying, but obviously geopolitical tensions.
Yeah. No, and I even though I know we're talking about China and central...
I just want to look at the yield reaction here. 10-year Treasury is almost down a full 5 basis points. But what's really interesting is the 2-year Treasury. The 2-year Treasury is down 8.6, so you're getting about it's about a 4 basis point spread between the two. So you're getting a little bit of steepening between the two. Let's see here. Gold is up slightly on this, and obviously we've seen the Qs bob around in reaction to this. You actually had quite a bit of a run there initially, and some of that has somewhat faded since then. Tesla's doing decently coming off that 221 line. Nice rally there after dropping below it. And you'll see, not a surprise, the higher quality mortgage companies doing pretty well here. Rocket, United Wholesale, as sort of the Fed's reiterating safety in some of that bond section. All right. Let's see. Recent data suggested the labor market had eased further. Average non-farm payrolls were smaller than the average pace of the prior session. Unemployment rate moved further up. Labor participation ticked up. Employment to population unchanged. Let's see here. GDP. That's fine. Staff review. Market implied path for the Fed funds rate moved down over the intermeeting period. Higher odds on a larger policy easing by early 2025 than they did before the June meeting. Consistent with the downshift in the implied path, Treasury yields moved down on net, with the most pronounced declines at shorter horizons, driven by decreases in inflation compensation. This makes sense. Broad stock indices rose slightly on net. Okay, so let's see, what else? Leverage in the financial sector was categorized as notable. That's not good. I don't like hearing that. Regulatory capital flows in the banking sector remained high. That's okay. Leverage at life insurers was somewhat elevated. Funding risks were also characterized as notable. Not ideal. Staff economic outlook. Let's see here. The staff's inflation forecast was slightly lower than the one prepared at the previous meeting, reflecting incoming data. This is foreshadowing a weaker summary of economic projections in September, given that, now they think things are weaker in terms of inflation. Risks around the forecast were viewed as skewed to the downside because more persistent inflation could result in tighter financial conditions. Okay. Participants' view of current conditions. Longer-term expectations well anchored for inflation. A couple participants noted that inflationary pressures might persist for some time. I mean, they've been saying that forever. I'm just not seeing that. Limited wage pressures. As much as we want people to make more money, you don't want a wage price spiral. Outlook for smaller firms appeared more uncertain, while the outlook for larger firms appeared to have a stable outlook. This is why I think it's crazy when people want to invest in the Russell 2000 small caps. Pull this a little closer. Can I do that? Yeah, I just think that the risk over there is massive. Oh, that's not bad. I kind of like that. Let's see if I rotate that a little bit. There we go. Okay, not bad. Okay, participants discussed the risks and uncertainties around economic outlook. Upsides to the inflation outlook were seen as having diminished. That's fantastic. So less risk to the upside, while downsides of unemployment have increased. Better balance between the two. We saw that from Jay Powell. In their discussions of financial stability, participants who commented noted vulnerabilities to the financial system as they assessed warranted monitoring. Some observed risks associated with losses, unrealized losses. We've heard this before. Participants generally noted that some banks and non-bank financial institutions would have vulnerabilities associated with high commercial real estate exposure. Yeah, that's why I'm staying away from the small bank ETFs. Many participants remarked that because a few firms play a substantial role in the provision of information and tech services, there was an increased risk that cyber disruptions could have widespread effects. I believe that. Let's see here. TLT is rocketing. Let me see here. IWM in fairness is up 1%, and the Qs are up about 46 basis points. Snowflake reports earnings later today. Tesla's almost at a 1% up, and Bitcoin's up over 60,000 right now. I mean, this is as good of a tee-up as you could potentially ask for a rate cut. Majority of participants remarked that risks to employment goal had increased. We know. Several participants, oh, this is interesting. Several of them, let's see, remarked that reducing policy restraint too soon or too much could risk a resurgence in aggregate demand and a reversal of inflation progress. These participants pointed to to risks related to potential shocks that could put upward pressure on inflation, or possibly that inflation could prove to be more sustained. All right. Let's see here. In hold, they didn't agree to cut. We know. All right. Let's see what else. What else some of the suits are saying. So far, this is pretty benign and good. What's going over here?
Company leaders credited a few factors for the stronger quarter. Traffic across Target's website and stores jumped 3%. Shoppers bought more discretionary merchandise such as clothing and home decor. and customers responded to Target's price cuts. The discounter recently reduced prices on about 5,000 everyday and seasonal items, including...
All right. Several FOMC participants noted that leverage in the Treasury market remained a risk, and it would be important to monitor developments regarding the market's resilience. Yeah. Banking system was sound, but risks associated with the unrealized losses. Yep, those are some of the things we commented on. Okay. It's kind of news that some people wanted to cut in July. Let's see what else other people are saying. The market's roughly where it left off before this. Bitcoin. Yeah, Bitcoin's over 60K. Let's see what else. No, there's actually not a lot of commentary on this. Okay. Let's jump in. Let's see if the Doomers are talking about it.
Is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master, along with Tim Stanovic, live here on Bloomberg Business Week. Well, this next story, both troubling and sparking still many questions. It is among our most read on the Bloomberg terminal today. It is, of course, about the sinking of the yacht belonging to tech tycoon and former co-founder and CEO of Autonomy.
All right, I'm going to pull off that. Okay. Well, I think that gives us a read of the minutes. I mean, overall, bullish rate cuts there, eh? Question now is, do we end up inverting, getting a little bit more pain? So we'll see. But that's it for now. It's a little on the boring side, but hey, you know, whatever. Anyway, thanks for hanging out with me live. Wanted to go through it, and so we did. Pretty benign. Seems like we just set up the September rate cut. So some red flags in there, but we'll see. All right, anyway, thanks so much for being here. Not personalized advice. We'll see you in the next one. Goodbye. Good luck.